you. Welcome from the IIBA Tampa Bay, Florida chapter. This is our study group for June 22nd, 2023. This is our 83rd class. We're going to be working through the techniques of organizational modeling and SWOT analysis today. Our mission here is to bridge the gap between industry leaders and business analysts by building partnerships with professionals, educators, and employers so we may empower, instruct, and engage the BA community. Our BA community is worldwide. We have people that attend the study groups from all over the world, and we have people that watch the recordings from all over the world. So if you're participating in person, welcome. If you're participating as a recording watcher, you are also welcome. Reach out to us. Let us know that you're here. We have a variety of ways that you can reach us. This is our Thursday evening study group, 7 to 8 p.m. Eastern. We're going to be here every Thursday night with the exception of the month of July. We're going to take the month of July 2023 off. Past meeting recordings are listed here. Cliff has dropped those into the chat for you. We also have an IIBA website, Meetup, Zoom, Facebook, and 2 different LinkedIn groups. If you want to reach us, we're here for you. Watermark Learning has provided a discount coupon for us for 20% off of any of their products. They not only have business analysis products, but a few other topics. Their discount code is Tampa 21, and it's flashcards, practice study questions, classes, all kinds of things that they have. We are a volunteer-led organization. Cliff Gray is our president. Yulia is our vice president of finance. Caitlin and Priscilla are board members at large. My name is Thea Soren. I'm the vice president of career and professional development for our chapter. It's my job to help you learn what you need to learn. If you have questions, if you need mentoring, whatever you need, reach out to me. Reaching out to me on LinkedIn is the very best way to reach me. We need new board members. If you are interested in being a board member, even just a little bit, reach out to me or to Cliff and we'll see what we can do, either to allow you to do something that you haven't gotten to do in a while, something that you're very good at, or something that you want to learn. We need new board members. Also, being a board member gives you a different kind of credit for your certification, your recertification. So it's beneficial to be on the board as well as to present some of our topics. One of the reasons that our study group has accreditation with the IIBA is because we have CBAPs, people that have passed their Certified Business Analyst Professional certification. They are with us. You'll see Bob here, Robert Churchill up here at the top, and here's Yulia on our second. They have passed their certification. Bob has been a leader and a mentor of this study group since the beginning, and Yulia was a student for a while, and then she passed her test, and she's come back on to assist us, which is very, very cool. We have other people that have been students and obtained their certifications. Bonnie, Frank, Renu, Nino, Yulia, of course, Tish. Renu told me she's passed another certification, and I don't remember at the moment which one it is. So whenever I talk to her next, I'll get that and get that listed. Today, we're going to talk about a few things. We did have a different schedule, but the people that we're going to be presenting have not yet arrived. So we're going to switch over. Bob is going to talk about organizational modeling and SWOT analysis, 2 very critical techniques in the business analysis toolbox. They're part of our BABOK, our book of knowledge, business analysis book of knowledge, and they are the techniques that allow you to do quite a number of very interesting things. You don't have to use these if you're a business analyst, but knowing what they are, knowing what their strengths and weaknesses are, benefits you in as far as being able to explain them and decide when they're good to use. So I'll turn it over to Bob. Take it away.
Well, to begin with, Renu is in fact here. So if she wants to start off with financial analysis, that would be just Dougie, but Bob.
Thank you, Rob. Yeah, I am there and I can go for financial analysis. Yes, today.
Okay, you got it.
Okay, so I'm going to share my screen for that.
Let me say that whenever you first present, learning how to share your screen and stuff is just a thing that you have to learn. We will always give you patience.
So I hope you can see my screen now.
Yes, we can.
Okay, perfect. So hello everyone. My name is Renu Jain Patial, and I'm gonna present the technique financial analysis, which is technique number 20 as per BABOK. And we are going to cover what is financial analysis, some ways to calculate do financial calculations, and some important points to remember for the CBAP exam, and what are the usages of this analysis and strengths and limitations as per BABOK. So financial analysis, sorry, so I cannot see the screen. So just in case you have a question, just pop in, let me know.
Okay.
So financial analysis is something that we do in our everyday life as well. Whenever money is the as money is the most important part for everyone. So anything that we do a financial analysis unconsciously, right? We have to buy something, we have to rent out something, we have to go for a trip. We do that financial analysis. So we are there are lots of things like budgeting that we do. So, but when we talk about business analysis fields, the concepts are the same that we use in our everyday life, but there are specific terms that we use, specific terminology that we use, and there are some rules that we have to follow. So financial analysis, if we talk about in words, is the assessment of the expected financial viability, stability, and benefit realization of an investment option. So like when we are going to invest somewhere, we want to see whether it's viable to spend there, whether the investment that we are going to do is stable, and whether it will bring us some benefits or not. And it includes a consideration of the total cost of the change, as well as the total cost and benefits of using and supporting the solution. So it's not just a one-time investment that we look at. It's not one-time cost that we look at. We also look at what all further costs we are going to incur and what further benefits we are going to have by using and supporting that solution. So
I have a question about benefits. I mean, total cost and including maintaining is pretty straightforward. What they mean about benefits?
benefits is the returns that we are going to, yeah.
Okay.
Benefits are the returns that we are going to get. So mostly we look at, because we are doing financial analysis, most of the times we look at the financial returns that we receive in terms of rent, in terms of sale proceeds, in terms of royalty, lease, anything like that. But a lot of times we also look at the non-financial benefits, like if goodwill is generated, if we are retaining our employees more, if we are getting if we are getting more customers that hit on our e-com website, and more customers are, completing their purchase. So that are some of the benefits which do not directly give us financial benefits, but yes, they eventually turn out to be financial benefits. Yeah, yeah, Rob.
Thank you.
Let me just add that a benefit can be more money you bring in and also money you save from going out. So there are a lot of ways to realize those in benefit.
Right. Second point regarding financial analysis is that it is a combination of analysis techniques. And because every technique that we use has a different perspective, we just cannot rely on one technique and say whether we're going to make that investment or not. For everything, we have different perspective. And so we always have to look at multiple techniques. And financial analysis is continuously applied during the initiative to determine if the change is likely to deliver enough business value such that it should continue. So again, it's not a one-time effort. We have to continuously keep seeing that if something changes, then what are we still on the right track? Is this investment still going to be beneficial or not? And what if some circumstances have changed? What if we add in more investment? Are we going to realize more benefits? So it's a continuous effort. And when we do financial analysis, there are main 4 financial statements that we look at: balance sheet, income statement, statement of owner's equity, and statement of cash flow. So all of these are giving different perspective. I will just mention it at a very high level. Financial analysis is a very deep topic. So I'm just gonna mention it at a very high level. Balance sheet is a balance sheet wherein whatever we hold as assets and whatever are our liabilities, that should match. On one side, we mention all the assets that we have, like we have machineries, inventories, and we have bank balances and all that stuff that comes on the balance sheet's asset side. And what are the liabilities? If we have taken some loans, if we are to pay the employee's salary and all that, that comes in the liability side. Income statement is a regular profit and loss kind of statement wherein we add every it's a add whatever is we are doing on a day-to-day business, like we are giving rent, like we are earning from some other kind of rent. So that comes in income statement. Statement of owner's equity is the owner's equity, like what are the shareholders value, shares that they own, how much loans they have taken, how much profit they are making. And cash flow, statement of cash flow is all the transactions that happen in cash outgoing and cash incoming. So these are the 4 main financial statements through which all of our financial analysis is done. In next slide, I'm going to just on a very high level mention how these financial ratios, there are various types of financial ratios that are used inside a business, like to measure a return on capital investment, to calculate profit margins, to assess companies' efficiency, etc., etc. And if we go to I will share this presentation so you can take a look. I'm just skipping it for the time being so that we reach at the main part, how we calculate the various, how we do the financial calculations. And if we look at from outside perspective, an external shareholder may use financial analysis to see if to carry out the competitor analysis and determine whether to finance a company in the form of debt, assess how profitable a company is, and calculate tax liabilities or market value and so on. So from the perspective of BABOK, what we need to understand is how we calculate different financial parameters like ROI, present value, discount rate, net present value, IRR, and payback period. So I am gonna take you to these one by one. So ROI is return on investment, and return on investment is which we do every day, in our everyday life as well. We just see how much we are going to invest and how much returns are we going to get out of it. So the formula is total benefits minus cost of the investment, and we divide it with the cost of the investment. So for example, if we are spending $1,000 and we are getting $1,300, so our ROI would be the profit is of $300 divided by the cost, which is 0.3. ROI is always in the form of percentage. So 0.3 is 30%. And higher the ROI, better is the investment. So the BABOK questions usually come in this form, like they ask whether the one should go for the investment or not based on, they will give some values here and you ask you to calculate the ROI or ask you whether the investment is a good option or not. So you can see you can compare between the two investments if ROI is one of the parameters.
Actually, on real CBAP exam, I was asked to calculate ROI.
Yeah. So simple, calculate the profit and divided it by the cost, the amount that you spent to get that profit, and convert it into percentage. So
So
when you
what do you
make,
think is, yeah, I have a question. So what do you think the ROI is better? How many percent is a good idea?
no, it's not how much percentage is good. It is, you always compare it. So if you're, when you go to make a financial decision, you look at multiple options. So you can take option one, you can take option two. So you will calculate the ROI for both the options and then see which of these has a higher ROI. Like if you say I spend $1,000 and get $1,300 in, that's the option one. But the other option could be you are going to spend $700 and you are in return getting $1,400. So which you think is the better option? Just think about it.
B.
Yes, because you are getting 50% there. So that's a better option. You're spending 700, but you're getting 1400, right? It's 100% actually, sorry, my bad. You're spending 700 and you're getting 1400. So you're getting 100% returns there. So B is the better option. So it's always in terms of percentage.
So, and basically, return on investment, what percentage is good? It's going to be up to you and up to your organization.
Yeah.
So in some companies can decide, okay, we are not going to take a project is IRR is less than 30%. I'm just speculating right now.
Yes.
So they have some kind of benchmark.
Yes, absolutely. Yeah. And plus, as we mentioned, that ROI is just one technique. There are other techniques too. So you always look at multiple techniques all together and then you make a decision finally. Okay. And for ROI, when making a comparison between potential investments, the business analyst should use the same time period for both. So this is also important. Sometimes the question may mention some investment, some returns to be coming in 6 months, but some other option may be giving you returns in 1 year term. So you have to make the time period same. It has to be annual or 6 months. So you have to do that calculation accordingly, right? So that was about ROI. And now we are going to go to present value. So present value.
Before we leave ROI, I'd like to mention two things. It's important that whenever you're talking about ROI, that you talk about what happens if we don't do anything. What would be the cost of not doing anything? And there's also in the real world, not in the BABOK, but in the real world, there's also what is the impact of change to our process and to our people. You know, you can have a thing that could potentially give you a 30% profit, but what would be the impact of change and how long would that process be in place? If it's a very short-term process, you know, it's going to happen for 3 months. It will give you a 30% profit. It only happened for 3 months. Is it worth it to change your process and then change it back? So you have to weigh all of those things on top of the ROI whenever you're talking about potentially changing something.
Right. So as was in the first slide, total cost. So total cost also includes any cost of using and supporting the solution. So as Thea just mentioned, if we are going with some option and then calls for additional costs, then we have to take care of those things as well. Okay. Thanks, Thea.
A pleasure.
So we move on to present value. So normally, when financial calculations are done, they go over more than 1 year. So the investments you make today may not realize benefits right away. It may take 2 years, 3 years, or maybe 4 or 5 years down the line when the investments start coming in. So initially, the investments may not, the benefits may not be high, but down the line, the benefits may start turning at a greater speed. So we have, while making a decision today, we have to calculate the present value of those benefits that we are going to incur after a few years as well. So how do we calculate the present value of something that's gonna be coming to us after say 4 years? So that present value is important, and for every return that we are going to get, we calculate the present value. So you all know the formula for calculating the future value. So what is future value is what is present value plus what is the interest rate that we are going to get. So if we are investing $1,000 today and if we are going to get 8% returns, then you can easily calculate the future value, right? So this formula comes up to be here. So we just calculate present value in terms of future value. What is future value? Future value are the benefits that we are going to get. We don't consider cost, present value of cost. We only look at the present value of the returns that we are going to get. So present value is future value divided by the 1 plus interest rate. So this formula you have to remember. It may come to calculate, they may ask you to calculate the present value of some option. So there will be some choices and then you can easily calculate that. So this formula you have to remember. I have put this one here because it's easier to understand it that way and you can immediately derive the formula on your own as well. So here is an example. So if future value is $1,000 and that's one for 1 year, if say interest rate is 8%, then the present value comes to be, sorry, if the future value is what, sorry, I
No,
should have
present
mentioned here,
value 1,000, then future value is
1,000.
going to be 1,080 with 8%
Yeah,
interest rate.
that's right. My bad. I should have mentioned what I'm mentioning here. So if present value is 1,000, then by the formula, future value comes to be 1,080. And accordingly, if we back calculate it, so present value by this formula comes to be $1,000. So this is just for reference purpose. I have given front way and the back ways. So when we calculate present value, we do not calculate it for just one period. So after 1 year, we may be getting some returns, and after 2 years, we may be getting some more returns, and 3 years, we may be getting more returns. So we actually calculate the present value for each term separately, and then we add them up. And that gives us the present value of the entire investment, entire option. So this interest rate is also called the discount rate, and that is usually uh, fixed by the organization internally or by looking at the external parameters which may be going across the industry. So we will come to the discount rate also in the next slide. So lower the discount rate, higher would be the present value. So this is important to remember because if you look at here, discount rate will appear on the denominator. So the lower the denominator, higher it would be the present, the answer. So that it's inversely proportional. So we have to remember that. And again, present value is expressed in currency, and higher the present value, the better the investment. Okay. All right, so we'll go to discount rate then. As we use in present value calculations, discount rate is what it is. Discount rate is the assumed interest rate used in present value calculations. And it is similar to the interest rate that the organization would expect to earn if if it invested its money elsewhere. So we look at the market rate, and based on that, we assume that for 1 year, like when you do investments, you know what are the rate of interest you are going to get on 1 year FD or on 2 year FD or 3 year FD. So for every period, you have a different rate of interest, and that rate of interest is used as a discount rate when making the present value calculations. So if you're getting a return in 1 year, use the interest rate that you would have earned in 1 year. If you are going to get an investment after 5 years, if you're going to get a return after 5 years, then you use the interest rate that you would have got if you had invested that money in an FD, right? So organizations usually go by the interest that they would have earned if they had spent their money elsewhere. And many organizations use a standard discount rate, usually determined by its financial officers, and to evaluate potential investments such as change initiatives and so on. Sometimes a larger discount rate is used for time periods that are for more than few years into the future to reflect greater uncertainty and risk. So if we think that the investment is, we are making an investment today, but the returns are going to come after say 7 or 8 years, we don't know what will happen in 7 years. Everything, every political changes, economic changes, even natural disasters like COVID hit some time back. So all those increase the uncertainty of your investment. So if you think that they're going to be for a longer period, then you use a larger discount rate. So if the discount rate is high, that means your present value is low, right? So if present value is low, you are kind of going, you are kind of taking a narrow approach. You say you should always look at the worst possibility. So you are now narrowing down your profits so that you can make a better decision if the worst strikes. And lower the discount rate, higher is the present value. So is that fine? You have any questions? Or anyone wants to add?
You know,
Can you
one
give
thing
us
I've always
scenario?
found that was fun about this is when you compare US and like Japanese companies that do this, American companies, they're long-term, 2-3 years. Japan companies, 5, 10, 20, 30-year plans. I always found it interesting that the US a lot of companies in the US, it's what can you give me bang for my buck right now? And
Mhm.
they don't even comprehend what could happen in 20 or 30 years. Even though the assumptions could be totally wrong, but at least they've got it in mind. That's
We've got a
difference of
target.
mindset. Yeah.
Yeah.
There's another concept to throw in there. You'll hear people talking about nominal rates of interest and real rates of interest. So your nominal rate is whatever is actually being paid or what the investment is paying off for interest on a loan. And if you subtract the rate of inflation from that, you get the real rate of interest. So if the nominal rate is 8%, inflation is 4%, your real rate of interest is 4%. So they'll do that, and you end up with weird things like if they're not paying you as much interest as the rate of inflation, their real interest rate is negative. So you're essentially paying people to hold your money. You're losing money just sitting there. So there's this subject goes as deep as you want. Everybody in my family was in finance. As an engineer, I'm actually the black sheep of the family. So go figure.
Yeah, so that's interesting because when we compare our salary increase, right, in percentage with the inflation, we think that we are actually paying, right? Our salary increases do not happen as the inflation is rising in the country nowadays. So They are 4 or 5% raise in costs, but we are not getting that much rate. So actually we are losing money. We are losing our balances.
Yeah, I mean, I just started to work, but my boyfriend, right, he been working long time, and for all these years, he never been, his salary never was raised. On contrary, it was reduced.
Yeah. So
Wow.
that's if we look at the real rate, then we find ourselves at loss. Yeah.
Mhm.
So after present value and discount rate, we are going to get to net present value, which is very simple. Net present value is the present value minus cost of investment. So now when we have calculated the present value from various returns from various years, we're gonna add them up, and then we subtract the cost of investment and we get the net present value, which is also a very important term in the financial world. So lower the discount rate, higher is the NPV, because NPV is calculated from present value. So the same effect of discount rate happens to present value as well as NPV value. And present value and costs are in terms of currency, so is net present value. And higher the net present value, better is investment. So present value and net present value are similar. Only thing is they're here we are reducing the cost. Give me a sec, please.
It is challenging presenting.
So anyone have any questions about net present value? Or want to add something?
It seems to me that net present value should always be considered, because if you don't include the cost of investment, you're shooting yourself in the foot.
Yeah, and generally for a company to decide whether to pursue a project or not, they look at net present value. And if net present value equals to 0, basically you are break even, right? So some companies pursue projects even if it's 0, right? It means they are not losing money, they are not making money, but they have some kind of different value.
So yeah, that's the next concept, Julia, that you have just introduced, and that is called IRR, internal rate of return. So internal rate of return is the rate of return at which an investment breaks even. That is NPV is 0. That means now you have recovered all your costs, and now whatever happens going forward would be your profits, right? So every organization decides a minimum threshold, which so minimum thresholds that the organization expect to earn from its investment is called hurdle rate. So they decide that minimum they have to earn this much, and accordingly they calculate a hurdle rate. And if your IRR is less than that hurdle rate, then you should not go for that investment. So this is also an important concept. Sorry. Please give me a sec again. I'm so sorry.
Go ahead. Go ahead.
While she is recovering, I will share a few other things, and that is that future values and present values can be calculated across multiple time periods. So if you, for example, have a 12% rate of interest, you want to do a future value in your compounded monthly, it would be 1.01 raised to the 12th for each month. So you can calculate these things by year, by month, by day. is even a definition which uses logarithms and all kinds of crazy calculus that is continuous compounding. So as you make the time period shorter for a given interest rate, and make a smooth curve, and that works in both directions. So these, and there are also calculations that take into account the interest rate actually growing or declining at a given rate, and there are formulas and derivations for all this. And this is an old version, but the book I learned it out of is probably in its 12th edition now. And it really talks very clearly about all these calculations. You can no doubt find information online about these in various financial texts and so on.
But to pass the BABOK, you don't need all that information.
Right.
No.
To do a BA job well, it would be good if you had a good grasp of it.
I learned that in 1981, and the book really hasn't changed. They talk about computers and things like that, but the basic concept is the same.
Very good. Renew, are you back with us? Okay.
She's on mute, I think.
Yeah, you got something muted. We're not muted.
Am I audible?
Yeah.
There you go.
Now we can
Good.
hear you.
Okay, great. So, yeah, as Thea mentioned, the book that Rob was mentioning, that is a very good book for if you want to do the business analysis when we are doing that. But for BABOK, we did not go into that deep. So if you are only studying for the CBAP, then we don't need to go that deep. But if you want to do that analysis, then it's required. It's very essential. We need to have a handle on the financial aspects as well.
Well, let's face facts. Finance runs the world. The companies will do something to save a penny. So finance is just very important.
Yeah.
In
And
the state
sooner
of
or
our
later,
world.
yeah.
But let me say that as a business analyst, I've been doing this for 30 years. And fortunately, I've very, very rarely had to be responsible for any of this part of the projects. Occasionally, whenever I would create a business case, I would need to do something like this. But for the most part, as a business analyst, it's not part of my job. Fortunately, there are people that it is their job.
Yeah.
Knowing what
Yeah.
you're talking about whenever you talk to them and knowing what they're talking about makes it a whole lot easier. So don't get scared about this if this is foreign to you. Go ahead and Renew. Show us the next part.
Yeah. So, so internal rate of return is something that the companies calculate internally, and it is not affected by the external factors. It is not affected by any external influences. So as we mentioned, IRR is something at which the NPV is 0. So if you whatever formulas we just learned, if we put them back here, the net present value is 0, and it is the -1, that is the cost of investment, plus some of the benefits. So that's how we calculated the net present value earlier, right? Cost of investment, we can put it the other way also, sum of the net benefits for that period, that is the present value, minus the cost of investment, and that will be equal to 0. So and accordingly we get the IRR here. So now we don't have the IRR, so that is the variable here to calculate the IRR. And a hurdle rate is what companies have already determined by looking at the other financial aspects. And if this calculated IRR is less than the hurdle rate, then they don't go for that investment. It's not a good option. So this is another concept that you have to remember. It comes up in questions. It can come up in questions. And the investment with the higher IRR would be a better investment. That is another thing to remember. Okay. Next concept is payback period. It is payback period is the time period required to recover the cost, irrespective of the discount rate. So how much time we spend in recovering our costs, that is the payback period. And once the payback period has passed the initiative would normally show us net financial benefit to the organization, unless the operating costs rise. So I've just taken an example. Like if the cost of a bike is $100 and rent per day is $30, so in 3.13 days, the cost would be recovered, right? So 3.13 days is the payback period, assuming every day somebody takes our bike for rent, right? But if after 2 days, cost of repair comes to be $20, now the total cost is 120. So it would take 4 days to us to recover the cost. So the payback period would be now 4 days, right? So after this payback period, whatever income we are getting, that is all profit because we've already covered our costs. So everything that is coming after that is a profit, unless of course further costs are incurred. So there's no standard formula for calculating the payback period, and the time period. And for calculating the payback period, we usually calculate it in time period like years or months, right? Years and months. So in the next slide, I have summarized a few things, whatever we have done so far. One, a combination of analysis techniques are applied continuously, and higher the better. If ROI is higher, then investment is good. PV is higher, investment is good. NPV is higher, investment is good. IRR is higher, investment is good. But if discount rate is higher, it is not good. So lower the better. Discount rate lower, better. Payback period lower, better. Okay. Now there is another slide as per BABOK. Where are this technique used in which knowledge areas? So there are many knowledge areas, tasks where this technique is used. And I had once earlier shared a spreadsheet. It would be on the recordings place somewhere. That's a techniques, right? So I'm just going to show you how you can look at this technique and compare its usage in different tasks. That is normally useful when we know. So this is the sheet that I've shared. It would be there on the Google Drive, and you go to usage in each task. So we are doing financial analysis. So financial analysis here. I'll just remove the zeros. And so now you can see how this technique is used in each task, and you can compare actually, because sometimes because if you look at it this way, you will get to understand how this technique has a slightly different usage in each task. Because sometimes the questions also come in this form, like they will give you a benefit and will ask you which task it is you think it is. And if you know the difference, then you can easily say which task it may be. So the questions can come in a opposite, in a different, maybe coming from a different direction also. Like if you see, when you're planning a BA approach, financial analysis is used. It assesses how different approaches affect the value delivered. But if you're prioritizing requirements, then it is used to assess the financial value of a set of requirements and how the timing of delivery will affect that value, and so on. So you will get a comparative view of how this technique is used differently in different tasks. So this spreadsheet has for all the techniques, so you can make use of that as well. So Next is strengths as per BABOK. It is used to compare the different investments from different perspectives. Second, so assumptions and estimates are clearly stated. So when we are doing the financial analysis, we already mentioned the assumptions and estimates that we are using, right? So that if assumptions become incorrect, then we know that that's a risk. So assumptions are kind of risks. So we will take count of that as well. And it reduces the uncertainty of a change or solution, because now we are calculating something, we have some data to look at. So it reduces the uncertainty in future. And it allows the business analyst to objectively reevaluate the recommended solution. So since it is a continuous effort, we can reevaluate it if something changes, if some new information comes up, right? That is the strength of financial analysis. But if you look at the limitations, then as we mentioned initially, some costs and benefits are difficult to quantify financially. Like as I mentioned, the goodwill, the goodwill that a company may generate out of it, that's you can't say, you can't quantify financially, and you cannot give a number to it. An option may not sound that uh, good when you are looking at the financial numbers, but if you look at the non-financial benefits, it may be a good option. So we cannot do that here. And because financial analysis is a forward-looking, there will always be some uncertainty about expected costs and benefits. So the best example is about COVID, right? Nobody knew COVID would strike. So even though everybody had their estimates, assumptions, and taken account of everything, but still, what is going to happen in future, nobody knows. Everything can be go for a toss, right? And another limitation is that this, when you look at, you make the financial analysis and you look at the numbers, they may give a false sense of security, right? An investment that may sound beneficial today may not turn out to be that beneficial because of an uncertainty. The things may be changing, right? So financial analysis has its own strengths and limitations. And yeah, so you have any questions for me or anybody? Just please go ahead.
I'm surprised they did not talk about WAC in the book.
I'm sorry.
Say it
I'm
again.
surprised that I'm surprised they did not talk about WAC, weighted average cost of capital.
Weighted average.
Cost of capital.
Well,
Okay.
okay, whenever we
Walk-
wrote
oh,
the chapter,
y-
we had, they said like, keep it to half a page per technique. We couldn't put everything in there. But for the real world, that's important.
It's good for BAs to be able to do this stuff. It's more the realm of project managers and finance analysts.
Right.
That's why the PMBOK goes into this stuff in more detail. So there's two ways to approach this. From my point of view, I always say, yeah, I want you to pass the test. I want to help you with that. But what's more important to me is that you're a great analyst, whether you pass the test or not. And the more you know about this stuff, the better. All these books here are about economics, not finance so much, but pure theoretical and historical economics. And I just love the subject. There's so much to cover. What Renu talked about was everything that's in the BABOK and a little more. If I have an article that covers some of the same things on my blog, so you're welcome to check that out. it goes into more or less detail on different things. So, also I talked about that book, which is where I learned a lot of the calculations and theories and things like that. That'll stand you in good stead for your whole life. As you're doing all kinds of analyses and understanding what's going on politically and in the overall economic environment beyond what you need just as a BA. So if there's any subject you're gonna get more into than others, this is not a bad one.
I sent a message to the chat. I think it's important to talk about WACC versus discount rate versus internal rate of return. So what is the difference? WACC is weighted average cost of capital. It's calculated simply from the high level. A company can get money from equity shareholders, right? And from borrowing money, debt. So WACC is weighted average, is how much they took money from investors and how much they borrowed. So you calculate it and you get a percentage, right? This is how much it costs you to have this money. Discount rate, like Renu already said, is opportunity cost, right? What is the percentage if you take that money and invest somewhere else, right? And internal rate of return, I forgot, internal rate of return, your NPV 0, right? Your internal, so a company decides what is your internal rate of return before you do a project or invest money or anything like that. And then we have hurdle rate, right? Hold on.
Yeah, it was hurdle.
Yeah, hurdle rate is when what company decides the minimum threshold that they want to earn. And
Yes.
IRR is when NPV is 0. So they compare the IRR with hurdle rate. If IRR is less than the hurdle rate, they don't go for that investment. So both
Just
of
so
these
you know, companies have different criteria for deciding what markets they'll enter. Some just go in anywhere they can make money, and some play to their strengths. GE, when it was very successful, said they would not go into a market unless they were going to be either the #1 or #2 competitor in that market. I don't know by sales or whatever criteria they base it on, but top level management may think of all kinds of different things. Also, when economic times get tight, companies will buy jobs, so they'll essentially bid a job at 0 profit just to keep everybody paying and keep the doors open, keep the business running, so they can survive until the economy turns up again. So there are a lot of things to consider. What's in the BABOK is the basics. It's where you start from.
Do they not cover like the difference between the costs, like a fixed cost, variable cost, those kinds of things?
I talk about those on my blog post, but I don't think the BABOK goes into it.
Okay,
No.
because those are what we
BABOK
used to make a
does.
decision on, kind of like what you were just talking about, Bobby. You close down a factory if you can't meet at least your fixed cost. If you
Right.
can meet your fixed cost, you're still making, you're kind of breaking
Variable.
even kind of things.
And there are companies in the stupidly low below market interest rate environment we've been in for much of the last 20 years. You have a lot of companies where the owners of it and senior managers have done stock buybacks with debt. And you have these companies that will never really be able to pay off their debt, and they strip mine them of all kinds of value. And so you have what are called zombie companies. And we have a zombie government actually too. So when interest rates go back up, the budget deficit is going to explode. And all of these things are aspect of these calculations.
Okay, I want to reassure everybody, if all of this is brand new to you and you feel a little bit overwhelmed, only what's in the BABOK is what you have to know to pass the CBAP certification or any of the other certifications. The rest of this is superfluous but it is important that you have some understanding of it to be able to do your job well. We're coming up to the top of the hour. Cliff, can you talk a little bit about where people can find the past meeting recordings? And we will also talk about what's going to happen in July, please.
Sure. The Google Drive where we used to store the recordings has been moved. We actually ran out of space, so it forced my hand. Something I should have done a long time ago, but we created a YouTube channel. I've got all the videos from 2023, and I should have all the ones from 2022 out there shortly. It will only let you upload 10 a day. So it's not that I don't have them and can't do it. It's a limitation YouTube puts out there. So probably within a couple of days, I'll have everything out there, including tonight's. I'll have tonight's out there tomorrow morning, but those are out there. The Google Drive still exists. There is still a lot of stuff out there, like the presentations that are being given. There's copies of those. There's a copy of the BABOK. There's a copy of some other IIBA books that are available through their website that I put a copy out there. So there's a lot of stuff out there that wasn't just recording. So that link hasn't gone away. Feel free to take a look at it, but
Right.
The recordings have been moved to YouTube.
Right. And
July. Yeah, we're taking July off. Right there.
Yes.
We're gonna take a break.
so
We'll
we
be
have
back
one more meeting before then. Next week we will meet. The week after that, we will not meet until August 1st.
Yeah, I think
Whatever
is it
the first
August
Thursday in
3rd?
August.
Yeah, I think it's
August
now you're
3rd.
gonna make me look it up.
Everybody, race to look it up. I'll beat you.
August 3rd,
It's
yeah.
August 3rd. Yulia
August
beat it.
3rd.
Yeah.
There we go.
So we will meet in 1 week, and then we'll meet next again on August 3rd. And for July, you've got some things planned for us, Cliff?
July, I'll again be working with the YouTube channel. We are going to be doing a bunch of co-events, hopefully here with the South Florida chapter. And the South Florida chapter is hopefully going to be rolling their, they don't have a strong study group, so rolling it up in with ours, and then we'll be sharing their presentations. And also we'll probably be working with East Tennessee like we did that one event, what was it, last month? So we're going to try and do a bunch of co-op stuff. This break is going to give me a chance to focus a little bit on that. And we got some board members that we're going to be bringing on. So thank you, Yulia, and we got a couple others. So yeah, this is going to be awesome.
So let me talk about being a board member. If you give presentations, the time it takes you to prepare for that presentation as well as the presentation itself, you get different kind of credit for the recertification credit that you need to maintain your certification. Being a board member, you get different kind of credit. So you can only have a certain amount of credit just being an attendee at the study group. You need a variety of different types of credit to have the right number of hours to maintain your certification. So consider that. We will be back next week to talk about more techniques. And if anyone is interested in presenting a technique, reach out to me and I'll tell you which techniques are still available. We will get that done. All we need you to do is talk about what does the BABOK say, and then if you have any additional information from your professional work or from your research, present that as well. Doesn't have to be fancy. It doesn't have to take the entire hour. Renu, you did a fantastic job. So sorry that you got choked up during that. It's not easy to continue to talk for an hour, I promise. And those of you who haven't done any presentations, it doesn't have to be fancy or perfect. You speaking up just is pretty darn impressive, actually. And it looks really good on your resume and your LinkedIn profile, right? So reach out to me through LinkedIn. I'm available. I try to be as responsive as possible, and we'll get you taken care of. Okay, guys.
Just clarification, just 1 second. So we are going to give 1 hour for 1 hour of presentation when you prepare for presentation. And correct me if I'm wrong, even if a presentation, if 20, 30 minutes, we still get 1 hour. All right? Or not?
The time is for the time you spend. So if you present for a half hour, that's a half hour CDU.
Okay.
But if you're prepared for 6 to do that half hour, then you get 6.5.
6.5. Okay.
That's
Yes,
what
Important to
you
clarify.
Yeah. So we pay you in a way for doing presentations
and
for us.
that's for research, not for your initial to qualify to take the exam. That's separate.
Right. So if anyone has any questions, reach out. If I don't have the right answer, I'll try to find the right answer for you. Okay. Okay, guys. See you next week. Looking forward to it. Talk to you later.
Thank you.
Bye.
Bye.